Welcome to Without Boundaries, a podcast from Russell Investments. We're here to talk with the people behind the portfolios, the active managers from all asset classes who shape how markets move in the real world, and who help us improve financial security for investors around the globe. I'm your host, Jon Eggins, Head of Portfolio Management here and a Russell Investments lifer of 23 years. We know that the best ideas don't just come from a single source. That's why we look far and wide, spanning markets and asset classes around the globe to find the most compelling managers and insights. Today, we're joined by Rich Clarida, who's the Global Economic Advisor at PIMCO, but he's also a former Vice Chair of the Federal Reserve, and a fun fact, he's a musician and a singer himself. Rich calls our current economic moment the Fragmentation Era, and I'm thrilled that we're going to learn from Rich today, where we're going to explore what all this means for monetary policy and for investing. Hey, Rich Clarida, thank you so much for joining us. And if it's okay, I wanted to start a little bit with your time at the Fed. We heard a story from one of our colleagues that during COVID, you and Jerome Powell were doing a duet at the holiday party. Is that true?
We did a duet at the holiday party every year I was there. Oh, wow. 2018, 19, 20, and 2021. I believe in well, certainly one of them was done remotely by video, but okay. Pre-pandemic we performed in person at the Fed holiday party. That's right.
Oh wow! And so you're not just an economist; you're a musician. Do you have a favorite singer or artist that you want to share?
Oh sure. Well, of my generation, people either were Beatles fans or should have been. So yeah, everything starts with the Fab Four, and then you sort of work down the list from there. Okay, and as you work down that list, would you feel comfortable rating how good is Jerome Powell as a good guitar player on a scale of 1 to 10? And he's better than me. He's good. Yeah, he's good.
He's good. Okay.
He has a classic Martin guitar, vintage Martin guitar. Yeah.
While we're talking about Fed chairs, a question I was really keen to ask you is, if you go back through time, do you have a favorite Fed chair that you look back on, either past or present?
Well, I've known personally every Fed chair since Paul Volcker, and I had a chance to work with Paul after his time at the Fed, and with Chair Greenspan when I was Assistant Treasury Secretary, and have known Ben Bernanke for 4 decades, and obviously benefited enormously from being able to interact with Ben and Janet, and of course work closely with Jay. I do think that on the Mount Rushmore of Fed chairs is clearly Paul Volcker. So if I had to pick one, it would be Volcker.
Yeah, sorry, I'm kind of like asking you to pick your favorite child or your favorite dog or something there. So sorry, sorry about that. But good to think about the Mount Rushmore analogy. And the other thing, as I think of past Fed chairs and how the market views members of the Fed board as well, the market tends to describe everyone as like you're either hawkish or you're dovish. You have a version of how you like to self-identify yourself, or do you like to eschew those definitions?
I think most Fed officials, and I was certainly in this category, didn't think so much as an inclination to be hawkish or dovish as it was really a reflection of their take on not only the data but also on the outlook. For example, I tended to be during my time probably more of a productivity optimist than maybe others. And that's important because that shapes your view, for example, on the economy's potential growth and the inflation outlook. Now, whether or not that made me dovish or hawkish, not sure. The other thing, of course, is an important the vice chair, along with the president of the New York Fed, as part of this informal group referred to as the Troika, and certainly in my case, and I think in the case of Stan Fisher when he was vice chair, and Janet when she was vice chair, Roger Ferguson, Alan Blinder, and Don Cohen. I mean, empirically, vice chairs support the chair on the final decision, and so in terms of the way I voted, I always voted enthusiastically and in line with Chair Powell.
So, Rich, at a recent secular forum from PIMCO, you described the current environment as the fragmentation era. Can you talk about what that means to you?
Yeah, it was the theme of this year's secular forum. We published an essay in June. I co-authored with Andrew Balls and our CIO, Dan Iveson. And what we What we highlighted is that we really see the world in the process now of fragmenting along several dimensions. The world's fragmenting into regional security alliances, regional trading blocks, and currency zones. We're no longer in a world in which economics drives politics, but we're very much in a world in which politics and geopolitics drive economics. We entered the fragmentation era, both in the U.S. and in many countries with a huge stock of sovereign debt that limits fiscal space. We think that the process of fragmentation itself is going to be a driver of macroeconomic volatility and global business cycles. We think it's going to create winners and losers at both the industry level, the sector level, the company level, and maybe even the country level. We're not going to really have a playbook to follow. We think that the fragmentation process has been underway for some time, in particular in the fragmentation into regional trading blocks and potentially also security alliances. But we clearly acknowledge it's been accelerating in Trump 2.0. And then finally, we think there will be a lot of investment opportunities in a fragmenting world, so long as we understand the nature of that process.
Your last outlook, you flagged a little bit just the rising government debt and how that's impacting the flexibility of the fiscal situation. And one of the things that I was especially curious about is how much do you really think that's reflected in the term premium?
Sure. So not just in the U.S., but in most advanced economies outside of Germany and maybe Switzerland, actually Australia too. But most of the big ones have very, very elevated levels of sovereign debt. The U.S., because the dollar continues to be the global reserve currency, dominant currency, and treasuries remain the global reserve collateral asset. The U.S. is and has been on an unsustainable fiscal trajectory, but the U.S., because it benefits from this exorbitant privilege of being the provider of the reserve currency, the U.S. will probably, and we expect likely, will continue on this unsustainable path for some time, perhaps into the next decade. The late U.S. economist Herb Stein once said, quote, "Something that cannot go on forever will stop." And so eventually that unsustainable fiscal path will be made sustainable, presumably through some combination of tax increases and spending cuts. So the question is this very bad fiscal news in the price? And we think it largely is. I mean, the market knows what we know. I've also written on PIMCO.com and in other forums that it's important when you're thinking about the term premium not to get too married or handcuffed to any particular model, because the term premium is unobserved. And so in order to model the term premium, you have to measure it. So we look at 4 different measures of the term premium, and they all show that it has increased substantially in the last 5 or 6 years, probably by 100 to 150 basis points. So whatever the term premium was in 2019 is probably 1% to 1.5% higher than it was then. In terms of the absolute level of the term premium, the models that I prefer show that it's running somewhere north of a percentage point, which basically indicates that investors are expecting to earn 1% more per year by buying a 10-year treasury than they would earn if they just rolled over 1-year treasuries. And that makes sense to me.
I think you said something like if something that can't go on forever won't. Is it even worth trying to think about what a catalyst might be or what the tipping point or threshold might be before it finally starts to matter even more?
The one that would come to mind as being, outside of financial market reflexivity is under current law, both the Social Security and Medicare have a trust fund model where for decades they've been collecting more in taxes than they've been spending on benefits. And so there's an accumulated trust fund balance that is now being whittled down because now entitlement programs are spending more than is being collected in payroll taxes. But by law, once that trust fund balance is exhausted, benefits have to be cut immediately and will be cut immediately in the absence of congressional action. And those cuts are going to be significant, 20 or 30%. And so one plausible argument is the U.S. keeps kicking that fiscal can down the road until sometime in the next decade when the prospect of imminent benefit cuts motivates Congress to get its act together and to put the U.S. on a sustainable path.
That's quite insightful and helpful to think about what to look for.
Yeah.
I should have said earlier as well, mate. It was very kind of you to give a positive message to the fiscal discipline in Australia, my home country. So thank you for that. I wanted to ask a quick one. You talked about the term premium earlier, but embedded in your answer was a comment about this reserve status of the US dollar. So from what I can gather, you think that's going to mostly stay intact. You kind of you've shared that in your outlook. What's the more medium-term outlook for the direction of the dollar, though, in your view?
Well, we continue to think that the most likely path for the next several years is a gradual downdraft in the dollar's value. For a couple of reasons. One, the dollar entered 2025, entered Trump 2.0 presidency with a historically very lofty valuation. There are different models of currency valuation, but they were all pointing at the dollar being quite expensive coming into the year, really at levels that we had not seen since the 1980s. And so just on valuation considerations alone, we came into the year expecting some weakening of the dollar. Now, of course, that was front-loaded. We got a lot of weakening in the dollar in March, April, May, and June, during and right after the Liberation Day developments. But I did a piece which appeared up on LinkedIn recently, with just a graph actually, which illustrates that the most widely followed index of the dollar's value, the DXY index, has basically been treading water since it bottomed out in April. Now, that's not to say that we think the dollar has bottomed out. In fact, we continue to think the dollar will drift lower. But it also is we think consistent with our view that the dollar is not in or going to go into any sort of a free fall. If for no other reason, then there really is no viable alternative to the dollar, at least as compared with other reserve currency candidates. And so typically at PIMCO, when we look ahead, we limit ourselves to trying to look ahead 5 years. But we think at least for the next 5 years, the dollar will continue to be that dominant currency. And so while on a valuation basis, the dollar may drift lower, we don't see a collapse in confidence in the dollar.
Let's keep that 5-year horizon, if that's okay. And you described yourself as a productivity optimist earlier. I really would love to hear your take on how real is the sort of the impact of artificial intelligence or AI on things like the labor market, on things like inflation, as you look ahead?
Here, I think it's important to distinguish between different time dimensions. And so at present, and certainly into next year and probably the year thereafter, although AI may not be showing up in the productivity data, it's definitely showing up in the macro data. It's been an important driver and been an important source of resiliency in the U.S. economy this year. By certain measures, first half growth came in at just under 2%, right around trend level. And perhaps a third of that, maybe even somewhat more, is directly attributable to the tech CapEx boom. Now, it's not just data centers, but it's also investment in plant and equipment more broadly and in software. And if anything, we'd expect those trends to continue into next year. The harder question, John, is at what point do we see AI showing up in the productivity data? And then perhaps even more importantly, once it does show up, is it showing up in such a way that is augmenting labor, or is it substituting for labor? The good news is that across history, over long stretches of time, technology in the long run does tend to be labor augmenting. We're a much more productive economy than we were 30 or 40 years ago, and we have tens of millions of more people employed than we did. And so the good news is, at least on average, productivity growth does not come at the expense of employment. But as you sort of peel back and you look at individual sectors or occupations, there obviously are potentially huge effects on employment. The best example is the share of the U.S. labor force that works in agriculture, which is now 1 or 2%. And 100 years ago, it was
50 or something, or
yeah, the number of people it takes to produce cars in a modern automobile factory is a fraction of what it was 30 or 40 years ago. So we're confident that over time there will be first order sectoral implications of AI. It's going to create winners and losers at the sectoral level and probably in certain occupations. But if history is any guide for the economy as a whole, on balance, it's on net going to be augmenting labor, not substituting in the aggregate for labor. When you're looking, and I'm now maybe perhaps focused on the U.S., but I think it's relevant to other countries. The reality is because of demographics, and we're getting older, and the number of births per woman is below replacement rate in the U.S. and in many countries. And depending upon where we end up as a country in terms of immigration law, then the big macro problem of the next couple of decades could be not enough workers. And so it could be the situation that, yes, new technology is substituting for workers, but it's substituting for workers that we don't have, in which case we can have both more productivity and no rise in unemployment simply because we're substituting for workers that may not be here in the first place.
So outside of some of the official statistics and some of the high frequency data, some economists have informal indicators they look at. They give them a sense for what's going on in the economy. The classic, the famous Greenspan example was it like spending on dry cleaning and men's underwear or something like that? So is there a rich indicator that you like to look at that you wouldn't put in your models, but you're still interested in?
Well, I think one that is useful, and I think a version of it is publicly available, is at one point it was called the Billion Prices Project, something done in Cambridge, I think out of Harvard Business School maybe, and they have a publicly available version of where they're scraping the web every day, and they basically come up with a price index, which at least historically is correlated with the CPI. So you can certainly get some high frequency reads on inflation. Oftentimes when companies are reporting their results, they give information. FedEx will give information on shipments, or UPS on their business, and so there is probably available data that you can use.
I'm going to stay a little bit lighthearted for a moment, if that's okay as well. And maybe this is well known. I didn't know it, that at the Fed there's a barber in-house. Does the sign really say your growth rate affects my monetary supply? And are the haircuts any good?
Well, a little bit of history. So yeah. I arrived at the Fed in September of 2018. And at that point, there still was a room that was the barber shop. And I think there was still a sign that said barber. But by my time, the gentleman was not coming in. I'm not sure what that was about. The Fed relocated across the street to a renovated building, and that occurred after my term had concluded and I returned to Columbia. So I'm not sure if there's still a barber in the new building, but I believe the Fed officials, perhaps even either Ben Bernanke or Greenspan, wrote about the Fed barber in their memoirs. But
yeah.
I never got a haircut at the Fed. I would have been happy to, but I never got a haircut.
It sounds convenient to me. And then there's one final question that we wanted to get to as well, and that's just related to your favorite Fed chair in history. Is there an academic or an economist from history you'd love to meet that you haven't?
Oh my. Well, I guess if you're a macroeconomist, you want to say John Maynard Keynes, who by all accounts, in addition to being brilliant and incredibly influential, was also an incredibly fantastic dinner guest, maybe after a brandy or two. So I did, but the question was that I'd not ever met. I did meet Milton Friedman twice, but briefly at a luncheon hosted by John Taylor out at Stanford in, I believe, 1999 or 2000. And that was a real treat because so much of my professional careers and academic macroeconomists had been influenced by Friedman. So it was really neat to meet him and to be able to tell him that in person.
I'll put you down as Keynes for the technical version of the question, but both quite something to have met him as well on Friedman. Hey, thank you again, though. This has been both insightful, but fun to hear your both the history and current take on markets. So to finish us off, Rich, we like to play a little game where I'm going to get to sense your level of risk aversion. And so what I'd like to do is I'm going to ask just a couple of quick questions, and I'd like you to give one of two answers, if that's okay. It's either you're going to take a chance or play it safe. The first one we already talked about a little bit, singing in front of your colleagues. Take a chance or play it safe?
Take a chance. It's not a chance. I'm a show-off. Easy, yes.
For me, that would be a bigger risk than for you, perhaps. Extending an already very long policy meeting.
Oh, yeah. Take a chance, yeah.
String that meeting out. Betting on AI being truly disinflationary.
Eventually, take a chance.
Eventually.
Wow.
Eventually. Commenting publicly about central bank independence.
I do it all the time. Commenting carefully on central bank independence, yes.
Commenting carefully. Well, thank you again. Like I said, not just the time that you spent with us in July, but being willing to sort of prepare and be with us here today. But really appreciate it, mate. Well, mate, that's our show for today. Remember, in your personal life and your investing life, keep breaking boundaries.
This podcast is intended for informational purposes only. The content provided within the podcast should not be construed as investment advice, research, or a recommendation, solicitation, or offer for any specific Russell investment or other product, strategy, security, or service. The information does not take into account the investment objectives or circumstances of any particular investor and may not be appropriate for all investors. All investments carry a level of risk and do not typically grow at an even rate of return and could experience negative growth. Any past performance results should not be seen as a guide to future returns. All opinions presented are as of the date of the recording and subject to change without notice. Information contained within the podcast is obtained from sources believed to be reliable but not guaranteed. Reliance upon the information provided in the podcast is at the sole discretion of the listener. The general information contained in this publication should not be acted upon without obtaining investment advice from a licensed professional. This podcast may involve discussions with non-Russell Investments personnel. The views and opinions expressed by non-affiliated personnel in this podcast are those of the speakers and do not reflect the policy or position of Russell Investments or its affiliates. This content should not be construed as a recommendation or endorsements of any third-party manager featured on the podcast. Some of the portfolio managers or firms featured in this podcast may manage funds or accounts that are offered by Russell Investments, and they may have business relationships with Russell Investments or its affiliates. Neither Russell Investments nor any of its staff accepts any responsibility for or liability with respect to the information or opinions contained in this publication. In EMEA, this content is suitable for professional clients only. Capital at risk. Copyright 1995 to 2025 Russell Investments Group LLC, all rights reserved.